Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 282 for November 30th, 2020. We are recording this at 1 p.m. Eastern Time. My name is David Kosmeter. I'm the creator of TimingResearch.com. And today, we're going to have a solo episode with the option professor. And you should be seeing his screen right now. And I'm going to go ahead and turn it over to him.
Okay, great, David. Thank you very much. Welcome, everybody. Optionprofessor.com is the website. And if you'd like to get a weekly update from us free of charge, newsletter that we put out each week, giving our opinions and our observations. At the end of the broadcast, go to optionprofessor.com and put your email in, and then you'll receive the information each week. Last week, we said, what are we going to see here going into the end of the year? Is it going to be a melt up, or is it going to be a pause to refresh? And again, this morning, it's a little bit of a pause to refresh. We're down about 25 points on the S&P and pretty much red numbers across the board. Something that happened today was the NASDAQ index, the ARMS index hit 0.32. Anything under 0.50 is considered panic buying. So there does seem to be a lot of panic going into whatever money's going in anywhere to the NASDAQ, because I think people are nervous again about the recovery and the status, and with all the travel, we hit post-COVID highs in travel, which could mean more hospitalizations and more fatalities and more lockdowns. And of course, the market got very, very exuberant last week because of the vaccines. To give you an idea how November has been going, to give you an idea, the Russell had its best month ever. That's a pretty big statement. And the oil sector in the S&P sectors up 32%, up 18% in financials, up 16% in industrials, and up 13% in materials. Those are big, big numbers for a 1 month situation. So we know a lot of money plowed back in here, and we know the exuberance got very, very high because the VIX got down to about 20. So, and the dollar index is right on the ledge as well. So you got a lot of stuff right on the ledge, and which way they're going to break will probably be determined by how the virus numbers come out and the inhibitions they put on the economy. But, we do this for decades, and so we're no stranger to what's going on. So I'm going to go over things that we've been watching and give you an idea of how we're following stuff right now. With regards to, we're going to start out with the stock market, and you can see right here on a 20-year basis, this thing is way, way overbought. And when it gets way, way overbought, as you can see, sometimes it surprises people. And the RSI here still looks pretty good, like it wants to climb. So that gives you some indication that there could be a big year-end rally and first quarter rally. But you can also say that there's a big divergence between the highs that were made here in 18 and 19. And of course, these are RSIs that are much higher, but they're reducing. We're still at a lower RSI here than we were here. So some people might call that a little bit of a divergence, and ergo it could be, a surprise if we start rolling over. Let's go into the shorter term stuff, and the 5-day has rolled over at 36.35 area. So we're rolling over on a short-term basis, on a monthly basis. It's on the verge. Like we said in the newsletter, if we break under 3,600, that could be telling us the pause to refresh is going on. You can see it's holding that now. And we also said that if we take out 35.20 area right around here, that would confirm that it's more than likely rolling over to the downside and correcting. You can see right here, the 35.20, 35.40 area would set up a move down here, which would be a pause to refresh. 6 month, again, if you break under this 3,600, that's your red line, right? And then you go to maybe test down here. How's the RSI look? Yeah, RSI is not really confirming any big move, right? So again, our feeling is obviously we're in a bull market, but adding to positions at the all-time high might not be phi beta kappa, and it can goof up a nice position, meaning you're up good money on your positions, you add at the wrong time, and now that breaks your break-even way up, and that could be a problem. So we are not advocating that. 3670 is the high on the S&P 500. Act as if it is the high until corrected. In other words, Until we see higher than 3670, I think the appropriate thing to do is to act like that is the high. And again, prepare for possibly a pullback. That doesn't mean sell out of everything, of course. It does mean that if you wanted to trim up at 3650 area, that wasn't such a terrible idea. And of course, if you wanted to hedge a little bit up there by selling calls or buying puts or doing collars, selling calls and buying puts simultaneously, that hasn't been a bad idea either. So again, if we take out 3670, then obviously we're off to the races again potentially. But if we don't, the enthusiasm, the low VIX, the tremendously high arms on the NASDAQ, that all gives you an idea that it's a little frothy. Okay, so let's go around the horn here and we'll give you some of the things that we've been watching. Now, tech is something that everybody is obviously very keen on. I'm going to show you an ETF. There's many of them out there. This one is going to be EGT. Hold on, please, 1 second. All right, now this is information technology from Vanguard. The spiders have one. Everybody's got a tech one. What's in these tech things? Generally Apple, Microsoft, Salesforce, that kind of stuff. Now, you can see here that this thing peaked out in September, right? And where did it peak out at? This particular one peaked out at 340, okay? It tried to get above there here. It tried to get above there, tried to get above there here. So far, it had not been able to do it. Now, again, it's still above the red moving average and the blue and the green. So there's still in an uptrend. What's the RSI look like? This is on a 6-month basis. It's just hanging in there, okay? Maybe this will get a bid if we get a bigger correction, because again, when people get nervous that the recovery is not coming as fast, today we had home sales that were down over 1%, which was worse than expected. So basically, some of the economic numbers that are coming out tomorrow, ISM numbers come out, payrolls on Thursday, jobless claims on Thursday, and payrolls on Friday. So there's news out there coming. Anyway. So this is, so now again, we were very, very keen on this back in the, I'll go back a year now. Let's go back a year. And we were very keen at the turn on this because we did think this was the place to be. So, March, April, May, this is what we were advocating. And I'll show you the other two we were advocating, which is semiconductors and consumer discretionary. But since September, this is where we were saying, look how far away from the averages you are. So this is where you do your hedging. If you don't know anything about hedging, you'd want to give us an email, optionprofessor@gmail.com, and ask some questions. We've been doing it for decades. Obviously, we know a lot about the subject. So the bottom line is up here is where you do your covered calls. Here's where you do your collars. And here's where you do your married puts. Here's where you do your trimming. Here's where you do your replacement trades, where you take off positions and replace them with call spreads. Much less cash risk out of the pocket. And then when it comes back down here, you got money to spend, okay? So bottom line is you can see here that it, until we get above this 340, again, this has been something that has been a resistance zone. But you can't deny the trend has been rising. And although it got broke a couple here, if you go back on a 5-year basis, you can see it hasn't been broken since the drop. So this thing got above the blue line. It's along all the way. Now, is it pretty far away from the blue line? Yeah, it is. So could we have a correction? Yeah, we could. So the bottom line, though, is it's very strong. If you're holding on, it makes sense to do that. But should you have some powder dry in case this thing is going to get filled in here a little bit? Yeah, probably not a terrible idea. Okay, now let's look at the semiconductors. And SMH is the one we use there. In the semis, you're going to find stuff like NVIDIA, AMD, Taiwan Semi, and Intel. The general index is way, way overbought. Obviously, that's dangerous when it gets that far away from the averages. In fact, that's historically going back, let's go back 20 years. You might not see too many times when it was that far away from the averages. Okay, that's 20 years. So does that give you an idea the semis are a little bit on the upside right here? Yeah. So you're starting to buy something here when the moving averages are down here. It could be trouble. So like I say, if you want to get into these things, getting them closer to the moving average has always been the better time to do it. Obviously, if you're in, that's where you get your gravy. And if you bought here, you're still making great money. But again, if you play with fire long enough, you tend to get burned. But a very strong sector no doubt about it, and making all-time highs here. Looks like very much so. Let's take a look at consumer discretionary. So again, we thought these were very good as we got into the turnaround. Okay, let's just give you a little shorter term graph here, like the 1 year, and you can see what we're talking about. Okay, right here, boom, 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 in the March, April, May, that's when you want to get in, right? Now, again, our thesis down here was as simple as this, is the Fed isn't here, so you can forget about defaults on the bonds and all that kind of stuff. They're going to back that. You can also see that they drop rates to zero. So now Tina's back in town. There is no alternative to stocks if you want to make some money. So the bottom line is that's why, and of course the stay-at-home stocks, we're going to use a lot of the semiconductors and the tech stuff. So that's why we were very, very keen on it here. And when it got way up here in the September timeframe, okay, we became less keen. Now this thing has made another big new high, but this RSI is not making a big new high. So okay, there's some risk here if in fact the appetite for these semiconductors were to change a bit, and also their valuations. Again, NVIDIA, huge valuation. Most of them are huge, which means what? If interest rates rise like they're doing now, you're going to have to reevaluate the valuation because of what? You have a higher interest rate multiple in there. And of course, that could be a caveat to, these things may still make a ton of money, but maybe they'll just compress their PE ratios. If they compress their PE ratios, even if they're doing great, you could still see some type of a give back. So you got to be careful there. On the consumer discretionary, that was the third leg of the three-legged stool that we had in the March, April timeframe. So if you're getting the newsletter each week free of charge, this is the kind of stuff we're talking about. Not bad. Now, again, you want to get into this stuff down here in the April, May timeframe. And now it's, again, way high with a what? A diverging RSI. So again, if the Christmas selling season isn't what it's going to be and all that stuff, sometimes things can mellow out. We've had big moves in some of the stuff like Starbucks and Nike and TJ Maxx and Target, Tesla, Home Depot, and Amazon. And this is the kind of stuff that you put into the VCR. So bottom line is that things are a bit extended here. And again, are we going to get a pause to refresh? As long as 3670 is intact on the S&P, having some strategy that the market may go sideways or pull back is not a terrible idea. Okay, now here's the stuff that we've been talking about getting into in the May, June, July timeframe. Okay, energy. Let's take a look at what that's done since the middle of the year. We can go back 6 months on that, and you'll get a better idea of what I'm talking about. Okay, go back 6 months, because that's 6 months ago. It's when we started talking about getting into this. Okay, can you see here that this thing didn't do very much, right? Trading between 40 and 46, but you got the buy signal here at 40, and the thing's gone very up nicely. Now, again, while it wasn't doing that well for us in some of these months, we were getting a high cash flow off the dividends. This VDE is well over 6%. Chevron is over 7% during that time frame. So again, you get into something down here because you believe what? That the energy markets will not be going down at $20 a barrel, and you believe demand will be coming back, and the shutdowns of the rigs and the shutdown of fracking is going to be helpful, and it has been. Now, of course, when it goes to 54 and the moving averages are down here, you don't start buying. You look for the pullback. Pullbacks towards where? Maybe 44 to 50. Well, 44 to 48 might not be so bad, or there's a gap there at 46. OPEC met this weekend. They couldn't agree on anything, so obviously that's why we're selling off here today. But again, the longer term, if there's a recovery, we do believe that there's value in the energy sector, and it is pretty still much discounted off their highs, of course. And the survivors should be able to make some money. That's our opinion, like everything I give you today, and that's our observation. All right, next one, and that's up 32%. That sector is up 32% for the month. So obviously, that's a pretty good jump. And again, when you're getting high dividends while you're waiting, nothing wrong with that, right? All right, next one is the financials, which again are up about 18% for the month. And here is one from Vanguard. Again, there's many out there. I'm just using this as these all as illustrative examples. And in here, you're going, now in the oil, you're going to find your Chevron, your ConocoPhillips, your Kinder Morgans, your Phillips Petroleum, your Schlumberger's. That's the stocks that you'd want to follow if you're looking at the oil. This stuff here in the financials, you know who they are: JP Morgan, Bank of America, BlackRock, Citigroup, American Express, Wells Fargo's coming on even out of the doldrums. But you can see here, again, big move up. And again, we didn't get paid on it for a while, but we were getting a good dividend. Now, obviously, we got well paid this month. Okay, interest rates are rising. That helps the banks. The economy's picking up. That helps the banks. The defaults and all the negative stuff on real estate, forbearance and all that stuff, maybe it's not in the price, or maybe they've overcompensated for it. That's something as well. But anyway, that's something we're keen on now, because this, again, still seems like it has a lot of runway to it. Next one is the industrials. Stocks like Union Pacific Railroad and UPS and Honeywell, Caterpillar, Raytheon, Boeing, Deere, even GE. These things are back on the bicycle, as you can see. And in the last 6 months, this is what we've been kind of accumulating. So there you go. Now, again, they didn't go right up. Some of these things weren't good for a while. But if you're getting paid good dividends while you're waiting, that's not bad. And if ultimately they bang up to the upside, that ain't bad either. So there's another one. Next one would be in the materials. And in the materials, you get different companies like Sherwin-Williams and Newmont Mining, Freeport Mining, Echo Lab, and Linde. These are the companies in the materials. Like I say, if you sign up to get the newsletter, we do go over some of the individual stocks in there as well, giving our opinion and our observations on them. So anyway, this is another one. You hold on for a while, doesn't do much, getting a good dividend, and then bang. Okay. All right. Let's see what else you got here. Oh yeah. Healthcare has not really been a secret to anybody. This thing is obviously been doing good for a long time. Anybody who's been to the doctor or hospital knows that there's a lot of money running around in healthcare. And healthcare, that includes your Johnson & Johnson and your Pfizer's, Abbott Labs, Medtronic, for those operations, Abbey, you got Thermo Fisher, and then you've got McKesson, who's going to be the distributor of all the vaccines. That's an interesting one, MCK. And but there you go. It's been kind of going back and forth, but it does look like if there's a surprise, it could be to the upside. And it's certainly been matriculating to the upside, that's for sure. Okay, now other stuff that we're looking at, we like stuff that pays dividends, right? Again, to go along with all that growth, a lot of people like to get cash flow. You can't get it out of money market anymore, and you can't get it out of bonds, really. So people are replacing that with what? With stuff that pays dividends, like this stuff. So this is an ETF, and then the ones that pay dividends, they got another one, VOOV, which is S&P. You got your Berkshire Hathaway, you've got your Merck, Pfizer's, you've got your telephones and your Verizons, you got your Walmart and Procter and Gamble's. And again, these things are paying dividends, and of course, you're getting paid while the thing is going. Okay? Doesn't do much, you're collecting dividends. Bang to the upside, there goes your principal to the upside. Okay? Again, not a bad place to have parked some money for part of the portfolio. Value is what it's called, right? Okay, these things have PE ratios, generally speaking, of 16, 14, 15, whatever. They're certainly not at 30, 40, and 50, and 500 like some of the tech stuff is, right? Okay, next one here is Russell Value. And Russell Value, again, pays a decent dividend. Excuse me. And as you can see, again, part of in the beginning of the year, it was consumer discretionary, tech, semis, right? March, April, May, June, July, August, this is the stuff. Okay. Now, this stuff here in this, what do you got? You got Disney, JP Morgan, Google, and a bunch of the other stocks we've already mentioned. So, you know, they're not unfamiliar when you pick up these kind of value indexes. Another one is small cap value. Okay. Here in small cap value, they got a GNRC, which is Generac, and then you've got some healthcare, MOH. You've got Peloton, PTON, and so you've got you know, quite a bit of stuff going on here. And again, this thing wasn't doing much, and there you go. Not doing much during the 3-4 months there, but bang. Don't forget, when you're just seeing it meander, you're getting a good dividend. Not a bad thing. Okay, and then you got mid caps, VOE. Again, these are illustrative. You can look up any of them you want. And on the mid caps, you're going to get things like Freeport McMoran, Clorox, Best Buy, Carrier, Motorola Solutions. And there you go. Doesn't do much, getting a good dividend, and then bang. Okay. So our feeling is when and if you get pullbacks on this, this is not a bad thing to accumulate. It's basically looking for the recovery to go and stick. And some of these things are not even at their 52-week high, where you know tech and semis and consumer discretionaries, most of them have gone way past their 52-week high. So we think there's good value there. Okay, so there gives you a little bit of an idea on some of the sectors and what's the reasoning behind it. Now there's these, I call them kind of modern day technology ETFs, which we had been very keen on. And if they have big pullbacks, we'll be keen on them again. Let me show you some of them. ARKQ, autonomous, right? Robotics. How's that been going? Well, again, something that we've been very positive on earlier in the year, right? And now obviously they're very high. So if we had big pullbacks, if the blue line can remain intact, then obviously this is something we'd be interested in because we don't think robotics is going away. But it certainly has been bid up. Okay. And next one up here is ARKK. And this one is innovation, you know, Internet of Things, that type of thing. And basically this one again, earlier in the year, very good to be in, and it's already had a big move. So if it had a big pullback and can hold the blue line, this would be interesting to us again. Next one here is SNSR. That's not it. SNSR. The Internet of Things. Thematic. They're thematic stocks. And this one has also been matriculating very nicely to the upside. So again, this is a lot of the, shall we say, technology and new wave, I call it, you know. Having been in this for decades, I would call it the new wave type ETFs. And obviously the money has been going into the new wave. But again, they are extended. So you're looking for pullbacks to see if you might be able to get in if it can hold the blue lines, which is the longer term moving average. Okay, another one out there is ARKG, which I believe is Genomic. Yeah, Genomic Revolution. And let's just see what they'll do for us here. Again, you know, I would suggest you look at the ETFs because what are you going to do? Stay up all night trying to find out which company is going to be the one that hits. So it diversifies your risk and they're doing the homework for you. If you want to do your own homework, what you could do is find out what their top 10 holdings are in all these things and then start looking at those stocks to see if there's any individual issues you find interesting. Obviously, they've done a lot of homework on these things, so you can look over their shoulder and see what their results have been as far as their findings on what companies are worthwhile for investment, in their opinion. Okay, next one up is Millennials. You know, Millennials is where the money is going to be going, right? All the baby boomers are going to be taking their inheritance over to these people. It's supposed to be a huge thing. And this thing here tries to track what these millennials are into. So if you look at their holdings, you'll see most of the companies you know by name, you know, that these millennials are using, are buying things from. So as you can see, this is another one that, has been on a very nice uptrend. And this is something I brought to everybody's attention in the weekly newsletter, free of charge. And obviously there's value to getting this information from time to time. So there you go with millennials. You want to play into the millennial market? That's one way of doing it. Then you got the cybersecurity. Everybody doesn't want to get hacked into. So you got hack, H-A-C-K is one, and then CIBR is another. And this one obviously has been another one that's been a steady winner here all year long. Now, when you get big drops in good things, that's when you want to buy, right? So you got an opportunity to buy at 33, another one at 33, gets above the blue line, you're back in the game. But again, they're extended now. Certainly something to keep on the radar. Then you got iPay, Visa, MasterCharge, right? You've heard of them. But what about Square and PayPal? So this lets you have mobile payments exposure. And believe me, it seems like this one guy was saying, I don't want to go buy something with a keypad, which I have to put my grimy finger on where somebody's grimy finger was. So there's a thing called touch payments. And you just put your phone, I guess, in front of it, and nobody's touching anything. And these people, some of these people are in the hunt with that thing. But you can see from 48 to 62, this has not been this is only 6 months. You go back another 4 months, and you'll see they were even lower. So the bottom line, this has been a great thing to be involved in with part of your capital as well. And again, when you get big drops in things that you think have value, that's the time to take a look. Okay, so there you go with that one. And then you got the cloud. So you got WCLD. And that had a big run. But again, the trees don't grow to the sky. And I think this one, while it's still up there pretty good, it has not been, taking out the high too much, but, it still looks very good. Obviously, the future of cloud computing is not going to go away because from what I understand, cloud computing can eliminate employees. When you eliminate employees, you don't have to pay them. You don't have to pay their insurance. You don't have to get a desk for them. So obviously, there's real economic value to cloud computing for the company because, again, it reduces their overhead for employees. Okay, so there you go with cloud computing. And of course, you want to know what their top 10 holdings are, go find them. And if you want to play pin the tail on the stock, they'll give you their universe of stocks that they think look good. Another one out there is a Sky, S-K-Y-Y. And this is another one on cloud computing that people are kind of keen on. So you got a couple of different ways to go there. And you'll notice this one has been a big winner as well. Okay, diversification, is the key here, right? You have a little bit of your growth, you have a little bit of these values, you got a little bit of these new economy or whatever you want to call these things. And the next thing you know, you've got a balanced portfolio that gives you a little bit of everything. And that's what diversification is supposed to be all about. International. Okay, we've pretty much covered the U.S. here. Let's talk. Well, one last thing on the U.S. is epicenter. What's epicenter mean? That means that when you had a virus and nobody is doing traveling, the rent-a-car companies are probably going to go way down in price, right? And then they're not going to go way down in price because people are going to start using them. And as you can see, that's exactly what's been happening here with Avis budget, which is something we were very much involved in as far as suggesting people take a look at in the May, June, July timeframe, right? Again, same thing with value, May, June, July, August, right? So you're accumulating in here, and now you're getting paid. It's pulling back a little bit, holding the blue line, hopefully, but this is called an epicenter recovery stock, and you can see why. Next one that would be like that would be the casinos. So there you got one for gaming. You know the casino names, MGM, Caesars. You've got the Las Vegas Sands. You got your Wynn. Boyd Gaming, maybe, I don't know. So this is a ETF that goes into all of them. And as you can see, in the June, July, August timeframe, if you think that a vaccine's coming, if you think the market will open up, then you get in and then you get a little bang here. And maybe it comes back down to the breakout point, which is around 40 to 41. And that might not be a bad place to look at it again. The other thing is hotels. So, of course, you got your Marriotts. And again, you'll see in the June, July, August timeframe, this was the time to take in there, right? And then now you're getting paid. Hilton Hotels, HLT. Again, our time frame on this was May, June, July. May, June, July shows you. There you go. And now you're getting paid. Coming down a little bit today, but again, if there's a recovery, these are the ones that should do a little bit better. They're still way off their 52-week highs. Then you've got K-Web, which is all the internet stuff over in China. We've been keen on this thing for a long time. One-stop shop, pulling back, but a nice run. Another one out there is your gaming. These guys like to, well, I'll give you a couple more. RCL is, I think it's Norwegian, right? Royal Caribbean, yeah. So there's your Royal Caribbean. If you look in the May, June, July timeframe, you'll notice that's the time to get on board. Pulled back a little bit, now you're getting paid. Same thing with Carnival. These guys got a lot of money through the debt market, so they got cash. They're going to give them the bridge till we can get back on these boats. That's the idea. Again, June, July, August, you're down here, and now you're getting paid. Okay, so again, and the other one would be airlines. So we go to jets. And here's your Delta, your Southwest, and all the other ones. You'll see June, July, August, boom. Now you're getting paid. Pull back, maybe taking a look at it. All right, now, international. International is getting a lot of action too. Here you've got things like Europe, which is supposed to maybe get Brexit passed next week or two. All they're arguing about is some fisheries up in Scotland or something like that. So anyway, but again, it's gone pretty far, right? I mean, again, this is more towards the value trade, had a big run, okay? So that's why you try to get in down in this area of 50, 49, 50, and then boom, now you're getting some action. Some different stocks in Europe would be Novo Nordisk. Still hasn't made his turn, so there's still some potential here. Untapped potential. You've got Roche. I don't know exactly if this is the symbol for it. Let's look it up. Roche Holdings. Let's see if that one looks like it. This one's probably had a good run. Nope, not yet. So again, some of these still have potential if they can get a little bit higher. You see, this is the 52-week high. So there's some real estate here. Then, of course, you can turn over to emerging markets in Asia and, your China large cap. China's done a good job at turning their economy around a little bit faster. And so that's why this stuff has been taken off a little bit. Again, similar to the value, time to get in was June, July, August, right there in the 40s, and now you're up here almost at 50. BABA. Is this a bargain or a bust? They're saying Ant is going to have trouble going public even in 2021. That probably is not great news. That's why it's down 11 bucks. So again, without Ant going public, people are taking the bloom off the rose here. So this is still on the defensive. Our feeling is between 200 and 240. It would be a neighborhood of accumulation possibly. If they take out this number here, you'll get that number. So keep an eye on it because, this is a company that is enormous and certainly worth a look. Then you've got emerging markets in, here's an ETF on one. They say if the dollar gets weaker, the economies pick up, these things should do pretty good. And they certainly are, but they're pulling back now. But again, in the June, July timeframe, May, June, July timeframe, where the value is also at a good time to look at it. Here you go. June, July, August, right? May even, right? You get in there. It's at 39. Now it's up here. Okay. And that's why we don't want to add up here. You add up here and you bought down here. Let me show you what that does. If you got 40, if you're in there at 38, 39 or whatever, let's say it's 39. And now you get in there more at 49 because you think it looks so good and you're making so much money. Well, now your break even is going to be at 44 right here. So it's very possible this market could correct down and take away a lot of your gain, and now you're goofed up because you added when it was way up. If you're going to add on anything in a bull market, it's always try to add on weakness. Okay. Let's go over a couple other things here. This is stuff we go over each week in some way, shape, or form, and this is the bond market. A lot of people are calling for 1.5% on the 10-year. Which would be very good for the banks. Here, we told people that when we were at 154, that's your buy point. So as long as we stay above 154, you should be looking for these yields to drop. Not for a long time, but for some time, okay? Now, so this is where we are thinking you should be long TLT, looking for yields to decline. If the stock market has a significant drop in the next 2 to 4 weeks, people are going to be very surprised, and it's very possible that they'll come into this stuff, particularly if the economic numbers turn south like the housing sales just did today. Also, unemployment. You got 20 million people still on the dole. That's a lot of people still getting assistance from the unemployment insurance. So, as much as we think everything's going to be great next year, they may have discounted a lot of that. And any sobering news, either on the virus or on the economic data, is enough to get some people to take some profits. And where they're going to go with their money, they may start locking in some of the longer term bonds, or at least park it there. And that's why TLT looks like it's trying to go higher. Again, that's your get out point at 154. And again, if it gets above 162, it could open the door for quite a bit. So keep an eye on it. Because most people are negative on bonds, and that means positioning means that a lot of people are short bonds. And when positioning is all one side, the other side can obviously make some good dough, because when all these people who are short want to get out, they have to buy in. And if there's a reason they're buying in, they could hike the offer and make you get back out of it at a bad price. Same thing on the long side. The positioning on stocks and tech got extremely expensive over in the September timeframe, and obviously that's why we've had some sell-offs. And right now they're saying the NASDAQ had a ridiculously high ARMS index, which is indicating that don't forget, if everyone's buying, somebody's got to be selling, right? If everybody's selling, somebody's got to be buying, and you got to figure yourself who's really got the better deal. If somebody's selling at an all-time high after a huge run-up, maybe he's not the dumbest guy on the block, particularly when everyone else on the block is yelling about how much money they're making and how strong the market is. So again, positioning where the market is very important in any of these markets. You get down to March and April, the whole world sold out of all their stocks. You don't have to be Phi Beta Kappa that there's not unlimited volume in any one direction. So once that volume dried up on the sell side and the Fed showed up, bingo, you're going to go up because positioning is leaning all one way. All right. So there's your bond market to give you an idea on TLT and on bonds right now. Let's look at a couple of other ones that have had big months, because maybe they're going to be a little bit more dangerous looking forward. High yield bonds, we're only 400 basis points between high yield and treasuries. That's pretty darn low. And so this thing has had a nice run from 83 up to almost 87. That 87 looks like a top possibly. So, if you're in high yield bonds thinking you're in money market, you could get a wake up call here pretty soon if the stock market is to drop and if defaults start increasing. So keep an eye on this. This pays over 5%, I think. So obviously that's why people buy it. But, you got to realize it's called high yield for a reason, which is a nice word for saying junk. With regards to one thing that we look at is VWEAX, which is the Vanguard high yield. And the reason we like this possibly is because their expense ratio is very, very low in comparison to the other guys, which means if your expense ratio is very, very low, you don't have to go that deep into the pond to get yield because you don't have to overcome a 1.5% management fee. So we think that there's value in the Vanguard area from the standpoint of they may not have to reach for yield as much because their expenses are so much lower. That's something to keep in mind. Okay, a couple of other income things here. Preferreds, they also went up pretty good. A lot of them are in the banks. So obviously with the banks doing better, that's why this thing did better. But as you can see, not a bad place to be. Not going through the roof, but this thing pays way over 5%. So that's not bad. And their principal certainly has either been stable or it's moving higher. Again, it could pull back a little bit if the market has a pullback as well. But keep an eye on this one because this pays a pretty good dividend or distribution. The next one on it is the tax freeze, which is something that's also done very well because the states are not in as bad shape, it looks like anyway, that people thought. And there you go. So you've had a move on this from the area of 115 up to 117, and you're getting tax-free income off of it as well, depending upon what state and your tax bracket and everything else. But that's another one on the muni side. And then you've also got international, which is emerging market. Now, again, obviously you got to be taking more risk when you're doing international, emerging market debt. But again, you've seen some of the Asian and European stock markets not doing so bad, and especially on Asia, obviously with emerging market. And you can see that you're looking at, a nice move of 3 points on the principal, and it's in the 4 to 5% range on cash flow or distribution. A couple of other things on that international front is some people are saying take a look at Latin America. Supposedly, obviously, there's risk there, but they have very cheaper valuations. So let's take a look. You see how it's it's turned here, and if you go back, let's see if you go back on a 5-year basis, what it's looking like. Yeah, you see it's just beginning to go actually. And there is some real estate. Look, this thing used to be at 40. It's still only at 26. So if you can hold the 22 neighborhood and, kind of hang in there, this could be a discounted value that could have a recovery. Mexico is one of the better performing countries in relation to the other countries. So that's something, and they're saying that a lot of the export market may go back down, or the production may go back down to Mexico. So again, keep an eye on Latin America. And then a couple of them in the area of Eastern Europe. People like to look at some things that haven't already gone way up, right? So here's another one that they think may have some value looking forward. And you can see it's trying, you got a higher low there. That's not bad. You take out 1800 here, and that would be something to take a look at. And then you got individual countries like Poland. And these are obviously higher risk because of their situation, but again, you get above 19 here, that might be something to take a look at. RSI is a little right around 50. So if you can get above 19, that could be turning these things up, and that would not be a negative. So you keep an eye on some of these things, see how they develop. Okay, let's go over a couple of commodities before we have to shut her down here today. And let's look at crude oil. Again, we've been kind of keen on the crude oil. Let's look at February contract. But, they did get some sobering news with the OPEC meeting. And so it is coming off a little bit. But the trends look like they have, again, turned back up after coming down. Had a very rough time here, right, in January to April. Came back up, pulled down, didn't take out the low, has now taken out this high. Could you pull back? Sure. But does look like these things are trying to turn up. I don't think we got 30 or 28 in the picture anymore. And we don't think, we think that going up towards anywhere between 50 and 60 is possible next year because of a recovery, which would mean your oil stocks may have a lot more to go as well. So keep an eye on that. Again, we've been believers that the electric cars are not going to take the fossil fuel cars out of business anytime soon. So that's why we're still a believer that this stuff may be of value, particularly since everybody is sold out. Again, positioning. You don't think everybody's sold out of oil this year at some point? all those companies, cutting back and closing rigs and all the rest of it. So that's your crude oil. And again, our feeling is we didn't think it was going to break 30 during this drop. It never did. And we still don't think, we think 30, this area here, is going to be intact. And we think this area up here is going to be happening based on a recovery. If it doesn't happen, of course, that's a different ballgame. Natural gas is a wild one. We were bullish on this at 2.00. It went all the way up to 375. Now, last week it pulled back to 278, and now it's at 282. So this is a wild ride. Yeah, can you see? That's a wild ride. But there is a stock out there that we like to use as a proxy for this called Cheniere, LNG. And as long as it's above 50, we feel pretty good about it longer term. And it's at 57. So once it got above once it got above 45 and 50, you see, that's when we got positive on it, and we remain positive on it. So, and what's the RSI? I'm sure the RSI looks decent too. Yeah. So basically, it's looking pretty good, turning into a 6-month situation. There you go. So that's why here to here, so you can pull back. There's room to pull back, right? Room to pull back. All right, let's switch it over to these metals, because that's a big story here, and I'm sure some of you guys who are gold bugs are looking for your can of Raid, because the bugs are biting you right now. Huh? So the gold has been a rough racket, but here's been our view, and if you got the newsletter, you would have heard this for months. We thought the move up to 2100 was a blow off top. Why did we think that? Because look how far it is from the moving averages, and this is on a 6-month basis. You want to see how scary it looks on this month? Look at this. Okay, here you're up at 2100, and the moving average is at 1700. Okay, so this thing was way overdone, and we thought it would go into a trading range of 1800 and 2100, which it did. You see 1850, 2100, which it did for months and months and months. We did think that if it broke under 1850, 1800, we could go down to a couple of different numbers. One would be into the 1750 area where we are now. You see those high points? So that's around 1750. That could stop there. Okay. If not, there is a longer term averages. Let me show you the longer term averages. See, we're coming into the first support, which is in the 1750. See where we're getting that from, right? And we have other support if they're going to really knock it down. And we have the other support coming in at 1550 and 1450 ballpark figure. So those are your next two support levels if we break here. Okay. Same thing with the silver. We thought the 30 was a top, and we thought that it would go into a trading range of 24 to 30, which is what it did, and now it's breaking down underneath the bottom of that trading range. 1800, 1850 was the support for gold. It's busted. And 24 was the support on silver, and it busted too. It's at 22. It's at 22, and we think it could go down to this 20 area, possibly. Now, on a 6-month basis, you can see that we would get very interested on this at 26 and change. Because if you can take this point out, which it hasn't been able to do, that opens the door for all this stuff up here, which is why we'd want to be in it. We don't want to be in it just for 23 to 24, 20, we're not doing that kind of stuff. We're wanting to be in it when it goes like this, when it goes like this. And it can't go like this if the moving averages are like this. You got it? So again, keep your powder dry. If you want to just dollar cost average and you have some kind of a point that you think it won't hit underneath, like it broke out about 19, so between 22 and 19 could very well be a buy zone. And then if you're looking to participate, GDX, GDX is obviously busted down. So then you go to your longer term graphs and see what they tell you. And again, just like gold, it could stop here on the one line, or it could open up and come down to where it broke out from, which is 30. Okay, RSI is still above 50, so it's still a decent situation, and it's still a bull market. Okay, but it is trying to come back down. And this is where, obviously, if you're bullish long term, you want to start accumulating on the pullback. GDXJ is your juniors. I'm going to go through as rapidly as I can some of these other ones because we've been telling people about this gold stuff for like since last year, and even the first 6 months of this year, which is really the best time to have taken a shot at it, to be honest. Well, let's go back 1 year, and you'll see what I'm talking about. Okay, we have the drop again, just like tech. Once tech got above here, that's where you want to be in. Okay, and when value became popular, this stuff became less popular, right? That's not hard to understand. A recovery is in the way. Well, then we're not so nervous. If we're not so nervous, we don't need gold. It doesn't produce any income. It has no internal rate of return, which means it doesn't have earnings and it doesn't have dividends, right? A piece of metal. So the bottom line is that when there's a lot of panic, yes, you want to be in it. And when there's not so much so. Okay, and those are your junior miners. Let's look at silver. These are juniors. Okay, good bargain down here at 7, not so much at 17, and on the defensive again. Trying to hold the lows at 13. Our feeling is it could go into the 12s. And SIL is another one. I'll give you some of the other ones that we talked about way before they moved. One is Pan America. And check a look at some of the runs that this thing had. Okay, I mean, 22 to 40 is not a bad deal. What about Royal Gold? This does a lot of leasing. Again, big run up. Not so much now. And let's look at what else we got here. Yeah, Wheaton. Okay, again, big run up, not so much here. Okay. Now, here's the other one. We talk to people about in the newsletter. You get this free of charge, FREE. And all you got to do is go to optionprofessor.com and put your email in. Okay, not a big deal. And we talked about this thing when it was in single digits because copper and gold have a ratio, and that ratio has separated. And it got so shorting gold, long copper has been the play, and it's been the play for many months. And this thing here, we picked up into the single digit area. Why? Because look, it got bullish down here at 6, 7, 8, 9, right? And now it's way up here. Okay, it's going to probably have a pullback, but that's been a nice ride. And another one is SCCO. Not many people talk about it as much, but it pays a decent dividend. So you get a dividend plus you get this stuff. That ain't bad. There you go. I mean, is that a nice ride? Okay, but they're overbought now. They're overbought. Okay, but when they pull back towards the blue line, then we'll take another look at her. So there you go with something like that. And then I'm just going to show you, we got a couple of minutes here. So I'm going to just close out with a couple of other things that are going on. One is the price of soybeans, which we told people about in the $8 range. And the March soybeans went up to the area that we thought it could, which is 12, and it's having trouble at 12. And so basically we're not constructive on it right now. And you can see, I'll show you why 12 was a number. You wouldn't know that from that chart, but since we've been watching it for decades, we can see 12 used to be the former high up here, right? So 12, let's see, what was the high here? 1208, what's the high over here? 12 even. So you understand? And look how far away you are from the averages, okay? So again, why were we positive on it in the $8 range? Because we didn't think it was going to break 780, bottom line. And we thought the Chinese were coming because they said they were coming. They came, 63% jump in demand about a month or so ago. So you don't have to be from Harvard to figure out why we got this pop, right? But again, will they keep buying at the same pace? Maybe not. And if they don't, who's going to keep the price up here? Maybe nobody. So that's why you have a risk up here. But again, this was the target price when we were down here, and it did hit the target. Okay, sugar prices got positive at 12:30. Why did it get positive at 12:30? Because that was when the 50-day moving average and the 200-day moving average converged. And take a look at what's happened since then. And let's get a shorter term graph on here, 6 months, so you can see it. Okay, see, 1230, the moving averages converge, okay, because this thing has been lower, has been moving up. So they got positive here at 1260 on the red one, right? Red turns up at around 1260. So you're riding it, you're riding it, you're riding it, you're riding it. It can't get above 16. And let me show you why 16 is important. See 16? Same thing with the $12 on the beans. You get beans above 12, you got a whole new game. You get sugar above 16, you got a whole new game. If you can't get into this area without going through that door. And the last one I'm going to show you is coffee, which was a good friend to us earlier in the year when we were positive when it was under 100. It ran up to 137. Then it pulled back to the support of 100, 110. And we thought it was positive. And now we think it's on the bicycle as long as we stay above what? 110. See there? Boom. So as long as we're above 110, and if we can take out 135, this opens up a whole new thing. So not, there's supposedly plenty of coffee out there, so that's why it's going to maybe not work. But right now, that's what it looks like to us. All right. Top of the hour. Again, this is optionprofessor.com, optionprofessor.com. You go to the website, you put in your email address, and then each week we will give you an update on our views, our opinions, and our observations on many of the things you've heard today, plus a lot more. So that's a lot of information. And then, of course, if you have questions, you simply go, hey, optionprofessor@gmail.com. I own this, and I want to know your opinion on that, or, what's your opinion and observation on this, and this and that. So optionprofessor@gmail.com. Shoot us an email if you'd like, and otherwise sign up to get the free weekly update. I'm going to turn it back over to David. It's been very lovely talking to everybody, and hopefully we'll be getting your email so we can remain in contact in the weeks, in the months, and the years ahead. All right, David, I'm back to you. Thanks a lot, everybody, for being here, and we'll talk to you soon down the road.
All right, thanks, Jim. Lots of good info today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory or app to get instant updates on all new episodes and events. You can also go to TimingResearch.com and you'll be able to get the access there to any of the recordings as well as the recording of this show as soon as I can get it posted. And just want to thank my guests again for today, the Option Professor, and check out his site at optionprofessor.com. Thanks, everyone.